Right, so my name is Sarah Lowther. I'm part of the Master Investor team. And I wanted to start off by thanking the audience. It's because of you that this panel is occurring now. Because of last year's feedback, this panel is back by popular demand. And by about 5 to 1, you'll find out why. Also, because of the feedback that you gave us last year, there was lots of whinging about this panel being on far too late in terms of the program timing. So we have elevated this panel to a lunchtime setting. However, I'm very, very keen that you go and see the discussions after us, also very high caliber. So we're actually waiting for one of our panelists. So when this happens, you can look at the panelists who've turned up on time and get their essence, and they can look at you to see if any of you are going to be potentially hostile. Because we've already had a bit of argy-bargy outside the pool beg stall today. Well, we had to get a security guard involved, so hopefully that wasn't you. Yeah, really. What happened? There was 2 people wanted to speak to the chief executive at the same time. So there you go. That's all it takes. So the format is it's 20 minutes. And we will be talking about the investment themes that my writers and podcasters have been covering, the investment themes that they think may be prevalent for the rest of the year, the stocks that they have talked about this year, and then anything that they feel you ought to be listening to, watching or reading that will inspire you. So, time check. Is he going to turn up? Right. We're going to make him do the walk of shame. Yeah, we could boo him. So as I was saying, this is the writers and podcast panel. So from stage right, coming towards me, we do indeed have Justin Waite, who's the founder of the SharePickers Investment Club.
Hello, everyone.
And author of How to Become a Microcap Millionaire. He has a stand here as well.
Just down there. Come and see me. Discount today.
There's Joanne Hart, investment editor at the Mail on Sunday, columnist that I'm sure you read on a weekly basis. We've got Jonathan Roy, founder of the UK Investor Group and owner of the UK Investor magazine. And when he turns up, it is Jonathan Davis, investment strategist and editor, Investment Trusts Handbook. And when he comes, maybe we could, I don't know, a little bit of a slow hand clap.
Boo him. Harsh. Boo him, everyone.
Yeah. Bit harsh.
Okay, right, we shall start. So let's put things into context because UK economic growth is subdued. Business costs are rising, but at the same time, price of gold and the FTSE 100 are trading near their all-time highs. So let's get a bit of balance. So, Jonathan, putting all that into perspective, what have you been writing about? What have you been featuring? And do you think the investment themes will be the same for the rest of the year?
I think largely we're going to see a continuation of the same themes for the rest of the year. We're seeing big concern around inflation still. I don't think that's going to go away anytime soon. Going into this year, people are hoping the Bank of England maybe going to be cutting rates 3 or 4 times. It looks like that's going to be maybe twice, maybe just once this year. So that's going to really sap. Jonathan, hello.
Sorry.
Hey, no.
I should have come last. I got a clap then.
I think that may cap investors' sentiment as we go through the year. But if you're looking at the FTSE 100, that's not really a reflection of what's happening here in the UK, and it being quite a defensive index, the UK equity space is probably quite a good place to be. If you see how it's performed this year compared to the S&P 500, that's really that defensive element of the FTSE 100 coming out. So I'm sure people in this room have quite a large proportion of their stock in FTSE 100 companies. it's probably a good place to stay there. I don't think we need to be looking too far afield at the moment. We want a bit of stability within the portfolios, and you get that from the FTSE 100.
But Joanne, you tend to be the champion of the small caps. So Jonathan's saying mainly FTSE 100 stocks, but do you agree?
Well, I think diversification is obviously a watchword. And yes, I write about small companies, I write about large ones as well. But I think the small companies are the ones which rarely get a voice. So that's part of the reason why I tend to write about them. Also, I feel that they deserve our support. And there are so many amazing entrepreneurs and incredibly dynamic characters within that small cap space that really you feel that the companies are going to do well. And quite often they do.
So Justin, you've written a book, How to Become a Millionaire, considering...
Microcap Millionare.
Microcap Millionare.
Yes.
But considering how this year has started in terms of the junior indices and the economic outlook, do you think it's going to be a long time before you write How to Become a Microcap Billionaire?
Yeah, I'll be dead before then. But no, as far as macro themes are concerned, as an investor, you've got to say, what can I do about that? And you can't do a lot about Trump's tariffs. You can't do a lot about the S&P falling over, wherever. I mean, all I can focus on are investments that I think will make sense. So regardless, there's always going to be doom and gloom out there. Always. There's never going to be the perfect time to invest. No one's going to say, right now, invest now. It's never going to happen. There's always going to be worry out there all the time. But doing all this worry, there'll always be great businesses doing very well, okay? And some of the best performers ever have been formed in recessions or bear markets, even depressions. So there's always good small businesses doing well out there. Now, as an investor, you can pick these stocks, or you can sit there worrying about the macro themes, which you have no control over. So I just look at it on a top-down level and think, from a bottom-up level, thinking, which companies are doing very well? Why are they doing well? What's the business model? And focusing on the growth they have, the products they have, because that's all I can control. I can't control what Trump is going to say. He can't control what he's going to say from one day to the next. Let alone me. So there's no point in me worrying about will tariffs hit this. So I focus on UK-based, microcap stocks. But they are high-quality businesses that are growing very well. And the reason why they're doing it is because they have something special. And so I'm looking for multiple returns on these companies over time, not pop and drops for stocks, but good businesses.
And we are going to be giving an honourable mention to some of the stocks that our writers and podcasters panel have featured so far this year. But Jonathan, you are aware which panel this is, are you?
Yes.
Very good. Right. So Justin just mentioned Trump there. I know I've used Trump, I think, 350 times in my writing so far in the first 3 months of this year. How could you Trump-proof your portfolio?
Well, you can't completely Trump. I got one here. You can't completely Trump-proof your portfolio. I mean, let's be clear about that. The American economy, the American government has got huge powers across to change things around the world. So, and some of the things he's doing are, well, I don't know what the opposite of creative destruction is. It's probably destructive destruction. They could end up very badly. There's some logic behind what he's doing, and I think one has to, whatever you think about the way he goes about things, there is some logic to what he's trying to do. He is trying to, reduce the deficit and so on. But can you Trump-proof your? Well, no, you can't. But you can. You could do quite a lot to help yourself, and obviously diversifying away from America would be a good idea if you have that kind of weighting everybody else, or the average person has, which is very significantly US-based because of its incredible performance over the last few years. But yes, so you want to own some gold, you want to own some equities in other parts of the world, and I think in relative terms they will do better. But you can't if he drives the American economy into a hole, there will be no escape from everybody else in the world. We'll all suffer to some degree, but we can prevent suffering as much as perhaps US holders of US assets will do.
So one of the reasons you were late was you were right at the front when Jim was giving his talk, and he was talking about how gold stocks tend to lag the appreciation in the gold price. Did he give any sort of further analysis about that?
Not really. I mean, he also said, of course, that gold miners will tend to lag the price of the gold problem. So even if gold does now moderate a little bit, I still think you should own lots of gold. I own a lot of gold myself. I think you should still own that. But gold miners maybe, but they're also looking at silver. So that will also help because the ratio between gold and silver is at a very, very high level by historical standards. So that would imply that if people are still moving into gold for whatever reason, inflation fears, geopolitical instability, silver might actually follow it quite soon.
Okay, let's get to some specific stocks now. And Joanne, you and I have given lots of column inches to a company called Hercules Site Services. I'm very fond of this company, founder-led. It's got an academy to bring up the next generation of sort of construction and blue-collar workers. And they've got an app, an employment app. So why did that company in particular feature in your column?
It started off because they are trying to match the employers, the builders of infrastructure around this country, with the blue collar workers who are going to do the building. And given that not just this government, but the previous government have all been highly focused on let's try and get this country's infrastructure back to what it was 150 years ago or so, you just think, well, this company has some of the answers, but also it's led by a classic, I think, small company entrepreneur, Turkish man, Brusk Korkmaz, came over to this country to do a PhD, I think, and never left. He's really passionate about the business. And I think that does go, if you're passionate about the business, sometimes you can get it wrong, obviously, but if you're working night and day, then I think that really gives a company like that the edge. I don't know whether you've ever come across Sigma Rock. Have you? It's a lime and limestone company run, again, actually by a non-English man, Max Vermeuken, who came to this country, I think also to study and stayed. But he is so passionate about building that business up and getting it going and creating a world-class business. Well, you've got to admire it, I think.
So who do you admire, Jonathan?
So I think, given where we are with UK markets, I'm going to pick out two stocks which are on one of the junior exchanges on the Aquis. They have a stand here today, so go and check those out. So the first one's Adshaw Services. It's a business assurance company and internal audit company. It has long-term contracts with government-funded organisations. It's got a market cap of around 2 million at the moment. It's actually got a yield of around 8%. It's one of the only companies on Aquis at the moment which is paying a dividend. And it's been steadily increasing that dividend since it listed in 2013. And the second one is also a Aquis-listed company in Majestic Corporation. So the audience may be interested to learn that there's more gold in a ton of refined mobile phones than there is in a ton of gold ore. And Majestic Corporation are an e-waste and precious metals recycler. They have a network across the world. They've just started to expand operations here in the UK, very much paying into the circular economy. They've just put out their final results this week, and we saw a 60% uptick in their revenue to $49 million. So very much a growth company, very much under the radar for those two companies. So two Aquis listed companies, and as I say, Aquis are down here. So go and find out a little bit more about getting involved in the Aquis exchange.
So Justin, you have a very excitable nature. So when you stock
Thank
pick,
you.
do the stocks that you choose, do they have the same energy?
Yeah, well, do you know what? It's odd because I have on my website, it's called the Microcap League. And these are companies filtered by their financial metrics. So I'm looking at growth, and that's probably the most exciting, or the most fundamental thing for a small company. They've got to have growth. But every company, 20 metrics they're analysed by. In fact, Hercules Site Services is in the top 10 of my Microcap League. So that shows it's a very good quality stock. But so I don't care about stories or anything like that. I'm looking at financial metrics. And why I built this site is because I discovered 60% of the best performers over sort of 3 to 5 years started at microcaps, sub 100 million, but they all had 5 other traits in common. A lot of it was growth. And I've created this website to find these next performers. So there's plenty of ideas on my site, but Hercules is one of them. Another one I quite like, this is I think is an exceptional company, and all I'm trying to invest in is good, great to exceptional businesses, which make up about, I think, probably 10% of AIM, because the rest is probably crap, let's be honest. Ignore the rest, they are rubbish. But look for great businesses. But one that I think is an amazing company, and it's now qualified to go in the Hall of Fame Microcap League, because it's gone above 100 million mark. It's a company called Beeks Financial Services.
Oh, I know them.
Yeah, and I think what they're doing is exceptional because they supply infrastructure as a service to stock exchanges around the world. So you get these tier one banks or asset managers who want to trade low latency on stock exchanges. Beeks will put their kit in exchange for them, and they can expand and deploy that as fast as they want, and they pay a monthly fee to Beeks. The funny thing is that these systems did exist beforehand, but tier one banks and asset managers used to have to pay for all the kit, all the IT engineers. They don't do that anymore because Beeks does all that for them. So what the exchanges have done, they basically are selling this kit on behalf of Beeks. So Beeks don't have to do anything. The tech is amazing. They've taken about 3-4 years to strike up these relationships with these exchanges, but they've recently signed NASDAQ. Now, if you understand that, you've got a small cap company, which is 140 million market cap. It just dipped recently, the share price. It's just signed the second biggest stock exchange in the world. Imagine all the technology out there trying to do what Beeks are trying to do. This little Scottish company have signed a NASDAQ. They've got a contract with the New York Stock Exchange, the biggest stock exchange in the world. They just signed with Johannesburg. They just signed with Mexico. All these stock exchanges are preferring Beeks technology amongst, well, you imagine there's probably loads of companies out there doing cloud infrastructure for exchanges, but Beeks are winning these contracts. And it's not only that, but it's not only the story of this, but they have had 25% compound annual growth, revenue growth for the last 5 years. And now they're starting to generate profits and free cash flow. So it's also backed up by strong fundamentals. So keep an eye on Beeks. Gordon MacArthur, the CEO, owns 32% of the company. When he first tried to come to the market, he was laughed out apparently by investment managers, said, you'll never do this. It takes too much capital, investment. He's now laughing as the company's like 5 times the valuation where it was when it came to market. And I think the target price they want to get taken out for is close to $1 billion. And their market cap is about 140. So, and I think he'll get there. I do think he'll get there. I think it's a 10-bagger. It's almost, you can never say it's going to happen, but sorry. That's what I'm so excited about. So look that up, Beeks. But I've got loads of ideas on my site, but that is an exceptional company, I think. There's very few of those, few and far between. Sorry, I've stopped now.
That's all right. No, never apologise. Now, some of the audience may have seen today's partial solar eclipse. So let's visualise it and use it as a metaphor. Just how can we ensure that no shadows are cast on our portfolio or something takes a bite out of it? So already we've talked about diversification and how you hold gold, Jonathan. So, what should we be doing to protect ourselves?
Well, I'm the opposite of excitable, I'm afraid. Partly because of my age, but partly it would be lovely to be 25 again and putting my money into the stock market then. So I'm the opposite of excitable, and I also, I only really focus on investment trusts, which are, they were designed to be patient capital. They're brilliant long-term investment vehicles, and they've been going through a very bad patch. So, but I do think there's an awful lot of opportunities there at the moment. I mean, till about 18 months ago, I was actually very negative, very cautious about getting involved in the investment trust world as a new investor. But now I think there's some tremendous opportunities there, which will offer you protection by virtue of being very cheap and being trading at a big discount. With the big caveat, which I think applies to some of the other things we've been talking about, there is this problem of liquidity in the UK market, and particularly the lower down you go the market cap scale, the more you're going to have liquidity issues, and the more you might also have some regulatory issues. I get a lot of emails from people who are complaining about the fact that the regulations preventing them from actually investing through platforms in some occasions. But so if you stick to some of the better known names in the investment trust world, which I'll be talking about later, another session, there's quite a lot of good things there, and certainly ones trading at big discounts. And some of the alternatives are finally beginning to look, I think, really attractive, 9-10% yields with some prospect of either being taken out if they don't perform, trading at discounts of 30% or so. I mean, that is a kind of once in a generation opportunity. I think we'll see that in a few years' time, but quite how quickly, I couldn't tell you.
Mention one by name.
Mention one by name? Okay. We'll find out if there's one Jim mentioned as well. Some of the battery storage trusts look very interesting. They've sold off a lot, but they do seem to have some kind of future. They're trading on 50% discounts, okay, offering a decent yield. I mean, there's lots. If you want something more conventional, boring, we'll see you through, something like Fidelity Special Values, trading close to its widest discount. Very solid, fantastic track record. Trades on about an 8% discount. Why would you buy a FTSE ETF if you could get a bit of that?
Yeah, so we've got a minute left each. So Jonathan, in terms of bingeable podcasts, research sources that you use, books that you've read, what nuggets of advice would you give the audience?
Well, of course, the UK Investor Magazine podcast should be at the top of everybody's list. Investing for the Best is a good podcast to listen to. And, really, I like to listen to a range of podcasts on specialist topics. So not the sort of big headlines, which would cover a broad range, but really getting into some of the obscure ones, into individual themes or sectors that might not be well known, but really sort of drilling down and listening around the subject, I find particularly interesting.
I don't like podcasts, so that's not my bag. But I read all the newspapers voraciously. I love The Economist. I think The Economist gives you a kind of an international perspective and a lucidity that you don't often get from the daily papers. And I spend a lot of time talking to companies and chief executives and just getting under the bonnet of these businesses and getting lots of stories.
So Justin, this is a question just for you. Are you looking over your shoulder wondering if you'll be replaced by AI in the near future?
Hopefully, yes. Knackered. Yeah, no. I think AI is going to help a lot. I mean, because essentially the financial markets are about data, and that's all I do is plug in data to my website. So hopefully it's going to help me. But it comes down to the stage where AI can't really, when you're talking to a CEO or you watch an interview with the CEO, it can't really get the sort of almost qualitative aspects of it, When you see a CEO holding like 30% of the company in his own shares, he started from day one and he's got a passion for it. AI can't tell you that, You can't see the passion behind the eyes. But it's going to be very good for, data, pretty much, and it'll just help us,
But there's one caveat, which is that there are often inaccuracies. I think the latest generation of ChatGPT, there's 30% hallucinations, that's what they call them, which is basically when they get it wrong.
Yeah.
So that's
probably more accurate than humans, though.
Well, there you go. We have run out of time, but didn't they do well? Jonathan, Joanne, and Justin. Very good. Thank you. Thank you.